Stuffy. All right. Morning. Good morning. How's everybody doing? All right. I'm glad that you all are here. Thank you for coming out on this beautiful morning. Got a lot to talk about, a lot to pack in, and we're going to go ahead and get started here. A little bit earlier than scheduled, but that's fine. Look, that's Ajay. You're correct. All right. Thanks. I'm going to go ahead and keep the jacket off this time. All right. So, everybody, thank you for being here. Again, my name is Brandon Ajay, CPA. I'm a CPA licensed here in Texas. I'm also licensed to practice in California, but I love Texas, my home state. And I pretty much have been a CPA for some time. I started my public accounting career in the early 2000s. One of my first clients was Enron. And then I was 10 years in public accounting. I started with Deloitte. I finished with PwC, PricewaterhouseCoopers. And then I spent a few years in public accounting for consulting, just on the consulting side. And then up until a few years ago, I was the assistant controller of a big major hospital in the medical center area until they got bought out. So I've had a lot of experience, and during all that time, I've gained a lot of wisdom and information and insight as a real estate investor. I very much love real estate. I love tangible goods. It's you know, the beautiful thing about it is you can touch it, smell it, feel it, see it, and take actions on it. And what I'm going to tell you all about today is essentially, obviously the title is here, the tax reform, but to give you an understanding of what tax reform has done and the implications for your particular industry and for real estate, and then help you find some ways that are going to be relevant for you building tax-free wealth and help you become more financially independent. All right, so let's dive right in. Since this is a matter of money, there's always got to be a disclaimer. So this is mine. This is basically just to show you that this is for informational purposes. And I am here, what I'm saying in here cannot be used to avoid any penalties that you may have already incurred. That's generally what this is. All right, so who here likes making money? Anybody? All right, all right, that's good. And who here likes keeping as much of the money you make as possible? That's even better. All right, so I'm not going to talk to you like you're a tax professional. You all are real estate professionals, and I suspect some of you are even real estate investors slash agents. I don't know if there's any brokers here, but even if there aren't, I'm here to talk with you in a way that is going to be plain vanilla. I'm from East Texas. I shoot from the hip, and I definitely call it like I see it. So what I want you to understand is I want you to be enlightened, I want you to be empowered and engaged. I'm going to give you cliff notes. Tax reform what has taken place with this tax reform. I want to give you a good understanding so you can see what specifically is relevant for you as a real estate professional. And then I want to show you some ways to fortify your finances, to fortify strategies that are going to be, and engage strategies that are going to be equitable for you as a real estate professional in this industry. Because I can tell you right now that the reform was really geared towards business owners and real estate professionals. Whether you're a real estate investor, a real estate agent, it's really, there's a lot of tax-friendly benefits to that. And it's not without surprise, given a lot of the folks that's in leadership right now have a background in real estate. So that's just what it is. So without any further ado, let's give you a quick update on current events. So first, you all see anybody you recognize? Okay. Well, the person on the right, to your right, is Janet Yellen. She is very good at what she does, some would say. But just to give you an idea, you have this overhaul that's been the largest tax overhaul in over 30 years. It's huge. Nothing like this has happened, not to this magnitude. And even the one that was back then was not as overchanging and far-reaching as this one is. You also have the combination of mortgage rates. They're going up. As you know, back in December, the Fed Funds Reserve had decided to increase the rates. And that was at the behest of Ms. Yellen there. Buyer demand has definitely increased significantly. A lot of people are becoming, out of the recession more gainfully employed. We're supposedly at full employment or very close to there. So people are able to afford houses. They're able to afford a lot more things, have more disposable income. And then you have, obviously, inventory. For us here in Houston, we're significantly impacted because the inventory for Houston's market has been impacted by Harvey. So you're going to have a lot more people that are probably more than you've ever seen renting, or going for an apartment or renting out a property. That's going to be, because it's going to be easier to do that than pivot to buying a house, just because of the fact that you had so many, I don't know how many homes, but hundreds of, probably millions of homes of some form of fashion, whether it be a townhouse, a single-family dwelling, or what have you, that have been destroyed, gutted. 100,000? Wow. You see, that's a significant blow when we already had low inventory in 2017, in the summer of 2017. So that's going to do something that we know. I mean, when you have high demand and low supply, drives up prices. One of the things you're going to see about this current events is Janet Yellen, who was the former Fed Reserve chair as of Friday, her last day, she clocked out. She said a few things that were pretty insightful. She gave an illusion that the economy was a little bit bubbly, and I'm not talking about champagne. She stated specifically in her last interview, before she clocked out Friday, that she believes that the market valuations are a bit high. And when she said that, the market dropped over 600 points, 666 points. I'm not saying the devil's in the details, but that's pretty significant. And given the fact that you have somebody like her on her last day saying a comment like that, and this was the actual reverberation of the market experience, that's huge, because it hasn't had a drop like that in a long time, a very long time. So, plus with the Fed funds reserve rate, which increased 0.25% in December, a month later, it's up almost a full point. That's as of last month. So I haven't checked it today, or for the purpose of this presentation, but just to show you that kind of combination, the interest rates are going up. I've spoken with other mortgage brokers that have told me like they're forecasting 5% and up on mortgage rates. So that's going to be significant. And obviously, you guys have to pivot in a way that's going to be equitable for you. You're probably going to be more interested in being savvy about rentals and things of that nature. So that's why it's important to you. You got to be able to communicate this kind of stuff with your clients, or be aware of what current events are, even if you don't have access to the real estate, or Wall Street Journal or things of that nature. But we're going to go through some strategies that are going to help you engage in protecting your income despite all these economic items, as well as when you should act. Personally, I think the time to act is in the first quarter of this year. You got the new tax reform, and you have an opportunity that you can recognize that you can take advantage of. So basically, these are the highlights. I don't know if any of you all can read this, but I'm going to read it to you, just so don't worry. First, and I don't know if you can see, but I have little smiley faces here for something that's good, and $10,000. Spring Branch counties and all that kind of stuff. So that, I don't even know why they made that decision, but both the Senate and the House did consent on that. Some say that it's because they were, it was a red state, blue state thing. I don't know, but I don't like it personally. And that's something I would think would be very insightful information for your homeowners or your potential clients who are looking to buy, because that's going to affect the true cost of their home ownership. That used to be an unlimited number. Now it's capped. That's why I want you to be cognizant of it, and know that even if you have more than one house and you have a rental and what have you, those property taxes are capped in the aggregate at $10,000. So that's one thing. Now the mortgage interest deduction, they reduced. You could claim it even if your place was about a seven-figure spot, so $1 million home. Now it's reduced down to $750,000. That, however, does not affect HELOCs, home equity lines of credit, if they were for acquiring a rental or improving a property. But if you're using a HELOC to take a trip to Fiji for a family vacation, or if you're trying to pay off student loans with your HELOC, then that's going to affect that kind of interest. Pass-through entities. Now oh, hallelujah, this is good. All right. Pass-through entities, business owners, LLCs, they're getting a freebie deduction. And by that, you get to exclude the first 20% of income that you make. So if let's say you're doing a really good year, you got 150, 200,000, Or let's say in this example, let's go to the max, $315,000. If you make $315,000 or less and you have an LLC, you get to exclude 20% of that. So that brings that 315 down to around 250. So that's a huge discount for somebody that's making that kind of money. That means you don't pay as much taxes. That's a different tax bracket even. That's a very, very good thing. That is huge. So for LLCs, you know, as well as other, it's really pass-through entities. So partnerships as well, but for our purposes, LLCs. Bonus depreciation. This used to be $2,500 and under, you could expense immediately. What they've done is, in anything above $2,500, you would have to have depreciated over, you know, whatever the useful life was. Let's say 20 years or 27 years. What they've done is they've allowed you to take, if an asset has a useful life of less than 20 years, you can expense that at 100%. Basically fully expense it, fully depreciate it in the year of purchase. So that means if you buy, let's say you have a rental property and you buy carpet for that rental property, or you buy computers, or you're putting up a fence or appliances, you get to immediately expense that. You get to write that off 100%, 100% fully depreciate that in the year of purchase. So that's really huge, especially if you have rental properties or your own personal property that's set up for rental purposes or business purposes. So again, this is bonus depreciation if it has a useful life of less than 20 years. It even includes certain vehicles, certain cars. If the car is less than $50,000, 100% depreciation, fully expense. That's really huge. So that's just some insight there. Again, unreimbursed employee expenses, however, this is not so good. So let's say you're out working on behalf of your W-2 position or your 1099 position, and let's say you're not getting reimbursed for mileage, you're not getting reimbursed for uniforms, or you're not getting reimbursed for things that are relevant to you, or education. If you had to go pay $1,000 to, you know, go get something that's going to help you get a certification and they didn't reimburse you for that, you were able to claim that in your Schedule A and as a miscellaneous deduction and claim that unreimbursed employee expense. You're no longer going to be able to do that. Yes, ma'am.
So on this particular topic,
If they don't reimburse you, there's still other ways to address it though. If you have like an LLC where you have an expense for education, which we'll go back in a little bit later, that's going to be something that you'll be able to claim it under. 1031 exchange. Have you all ever heard of that term?
yes.
Okay, good. So y'all know what that means. So basically what they've done is they redefine it to where instead of me giving up a Lamborghini for a yacht, I can only do real property to property. So a rental property for a rental property, or a tangible asset for a tangible asset. However, they've gotten rid of the domestic production activity deduction. So basically if you're a flipper, you're a home flipper, and you're buying inventory, you're buying the pickets, you're buying the frame and all that, the materials, you can't, they've eliminated that deduction. So I think that's pretty negative for home flippers. If you're a developer, that's also pretty, not too good. Plus, they've taken away, they've reduced rehab credits. That's also not good. However, the rental income from a rental property is not going to be subject to self-employment tax. And self-employment tax, that's FUTA and SUTA, which is like 7.5% either way. It combines for 15%. For the rental income? Oh, you won't have to be taxed on it like so they were going to make it subject to self-employment tax, but they decided not to.
So it's better.
Yes, fair, yeah.
Another question. So
Okay.
you said that the last page.
Yep.
So how about
S-corps have a lot of advantages. Now C-corps even have even more advantages. But I'm going to talk about S-corps in just a bit. Let's see. All right, so now I've given you some enlightenment. I've given you kind of a synopsis of what has happened, giving you some cliff notes there. What I want you to do is say no to doing things the same as you did in 2017. No more same as last year. Yes, Sally, say no to Sally. Let's go on, we're gonna go into, how we're gonna help you adapt to this change. The thing is, how many of you all have a W-2 somewhere? Any of you? Okay. And then for the majority of you are full-time 1099ers. That's good, because at least with the W-2, you're able to pay taxes. 1099, you're not paying anything into the system. Then you end up owing taxes, and that really sucks sometimes. The thing is, either way, you're here, you're an entrepreneur, whether you realize it or not. You may have a DBA, you may have an LLC. It would be good if you get an LLC if you didn't have one before. It would be better even when you qualify to move up to a SCorp. These will help you protect yourself. You're an entrepreneur. You got to start doing things formally. You got to start doing things in a way that's equitable for you as a business owner. You want to make sure that you use this tax reform, take out what you need to understand to help put more money back in your pocket. Be different. It's a good question up here. Can you afford not to incorporate? Well, I tell you, you can, do without incorporating. It's your choice. You have the free will. However, the tax reform, can throw a mean right hook. The great boxer and philosopher Mike Tyson said everybody has a plan until they get hit in the mouth by me. So that is kind of, let's say Mike Tyson is a tax reform. Without the right guidance, it can throw a mean left hook, and you can end up like this guy here, right there. However, it's like I said, a lot of things to make sense of, and so you guys have to start recognizing the opportunity in front of you, not doing things the same as you did last year. You got to start getting a team together. You not just having employees, but a team of professionals like attorneys, a real estate attorney, a real estate CPA, some marketers, things of that nature. Incorporate yourself and take advantage of what's available. Now, I mentioned self-employment tax earlier, and just to answer her question, I did this whole slide just for you, okay? Well, self-employment tax is basically FUTA and SUTA. It's, with the W-2, you're paying 7.65% just, Social Security and Medicare. Your employer, however, is matching that. When you become an employer-employee, when you're on a 1099 basis or LLC basis, you essentially are paying both of that. So you're paying into Social Security and Medicare, and that's really what it is. So that's why it's around 15, a little bit over 15 a quarter. And so basically with the 1099, you're independent contractor, rule of thumb, 30% try to escrow for yourself. I mean, that's just what I've seen that kind of gets people at least in a refund position or at least safe when you don't have any other things you're paying to the system. There's all kinds of ways you can do that. In addition, I would just give you this quick scenario. The difference between a sole proprietorship, a LLC, and an SCorp is really nothing other than the tax treatment. The tax treatment is what makes the difference. It's how you elect to be treated. If you want to be treated like an individual, you can be treated like an individual. If you want to be treated like a corporation, that's also an option. But just to give you an idea with the tax reform, if you had a W-2 and you're a real estate agent, and let's say you have no LLC, you made $100,000, you're probably going to net around just under $75,000, all right? Just with the way things are. That's the new tax brackets, and it's 24% at that level. However, if you had an LLC, you're going to net about $83,000. That's a big difference. Reason why? There's a 20% exclusion that we just alluded to earlier. So that 100,000 is really 80,000. So it's 20%. That first 20% you get to exclude. And so then because of that, the tax rate for somebody making $80,000 in the new tax bracket for the tax reform is 22%. So that puts you around 83% net. You have S-corps, which in S-corps you have a reasonable salary, which is required, and then you have the self-employment tax and all that, but you're probably going to net about 85, so a little bit more, but it's an advantage either way. It's an advantage either way. So If you want to become an LLC, you can, because right now your check is probably saying, what is your name? Leanne. So your check is probably saying, Leanne, and thank you for doing all your good stuff. So here's your name on here. However, if you had an LLC, your LLC could be getting the name on that check. That way, it's not going to Leanne directly or Paul directly. It's going to be going to the LLC, and the LLC has better tax advantages because it's a business that's going to be available to Leanne. So this is how you do it, though. This is basically the order of operations. You get your designation, obviously, as a real estate professional, which all of you all here have, and then you let everybody know that you want to take advantage of becoming an LLC. So you tell your broker, you tell the Secretary of State, you tell TREC, I want my LLC to, afford my designation, and you go through the process. It's the letter of intent. You make this thing happen. You make sure that everything's okay with people like Michael and Gary and folks like that. And but you can do this is the process. This is the guideline. It's not difficult. It's just obviously your choice. And so next, if you decide, yep. No. This is for SCorps. So once you are eligible by the IRA, they're a happy medium between LLCs and SCorps. However, with the new tax reform, SCorps have some really great advantages, especially the fact that their max tax rate is 21%. So that's also something to think about. But traditionally, with real estate industries, LLCs and SCorps are the way to go. Yes, ma'am.
I'm an S-corp.
Okay.
What's the C-corp? What's that? What's the difference between those two?
Okay, so a C corp is a true corporation. I mean, it's not like a self-indulged corporation. You're going to be taxed twice, typically. It's really for bigger companies. They definitely are. They have advantages if it makes sense, But S corps, I think you're in a good spot. You're in a good spot. Yeah. So, how long have you had your S corp?
3 years.
You probably seen.
Real estate before.
Wow, smart. We got to talk. What's your name?
Tara.
Tara. All right, you're gonna have to come with me the next trip. All right, let me go to this next slide. Yep.
Go back 2 slides.
Oh, okay. That's. Execute. Yeah. So you're just once you're incorporated, you have your broker make sure that all your commissions are going to your LLC versus you from now on, and then that way you get the tax benefits. You got the. So once you have an LLC, you don't want to just have the LLC and just say, okay, I got an LLC. You want to do things like engage a CPA to help you have guidance there, because you still need to have minutes and board meetings and things of that nature, even if it's just you, because you don't want to have be negated by the IRS because of lack of compliance, and so essentially they can take away that designation and say, okay, you're just using this LLC to as a piggy bank, but actually when you have a bank account, minutes, things that actually show formal business activities, an accountant, stuff like that, resolutions for opening up a bank account, resolutions for hiring a bookkeeper and all that. When you have those kind of records and documentation, that is very advantageous to you. Okay, so okay, that's the what do you call it? The veil of what is it called? The corporate veil. That's called piercing the corporate veil when you don't do that, when you lack that compliance. Yes, sir. Yeah. So that's going to be a question for like Michael and them, because I provided them, but I know that they're putting it on YouTube. They're putting it on your YouTube deal. Yep. So that's probably how to be. And what's your name again? Bilton. All right. Good to meet you, man. So basically, here's the order of operations. Not doing things the same as last year. Recognize your opportunity. You gotta have the ability to make what you want to happen. You have that. Whatever your goals are, whatever your dreams are, you can become financially independent in a smart way, in a tax strategized way. Engage a real estate CPA. I think that's going to help you. I do tax prep, but I'm more of a tax strategist. I help you engage things that, prospectively. So 2018, 2019, 2020, help you see clearly, have clear view. Incorporate. Once you're eligible, make the election. You want to see this benefit, take the advantages of what's in the tax reform and make it work for you. Team up with a real estate investor, or any of you real estate investors. Okay, so you know about hard money and things of that nature. I think real estate investors, they don't necessarily have to be real estate agents, and real estate agents don't necessarily have to be real estate investors, but I think the combination of the two, when you have that in the team, especially with a real estate JD or a lawyer, real estate CPA, that helps you present a better case to the world for making more money and telling Uncle Sam, I know what you're doing, and I've gotten wisdom on how to mitigate what matters to me. And then seek a network of influence. So you gotta probably even get, in addition to those individuals I just mentioned, even a landscaping company, things of the nature. And landscaping, by the way, would be fully expensed within this 100% depreciation thing, which is also, if you're paying for that and you have a rental and you pay some guy, $10,000 to do a Japanese garden in the backyard, which probably add a lot of value to that deal, that'll be expense. So notice that this spells something. Real estate investment trust, right? You don't necessarily have to have a real estate investment trust, but I just noticed that it had that acronym. But REITs, which if you don't know what a REIT is, it's a real estate investment trust. It's a company that's just set up for the purpose of owning income-producing rentals, income-producing assets that are real estate based. So that's that. Now, here's something even more advantageous for you. You do one better. You get your LLC, you get your SCorp, you get engaged with the right type of tools, the people in your corner, CPA, real estate CPA, or real estate JD, things of that nature, people that's a real estate investor. You work with them, and then what you want to do is answer these kinds of questions. First question, do you like the idea of paying 30 to 35% or higher when you retire on your retirement, that you may have caught up in a 401k or something? I don't like that idea. 401ks are very 20th century. We're in the 21st century now. So there's ways you can take an action to mitigate this risk. Would you want to know a way that's better than a 529 to save for your child's college tuition? How many of you have children, by the way? All right. We're going to talk about that because they're in school, but they can still be at work, even under the age of 16. We'll talk about that in just a bit. So if you have, and then I guess, would you like to generate passive income and just see those returns come back to you in a tax insulated fashion? You can do that with the self-directed IRA. The self-directed IRA is a beautiful thing. Maybe some of you have them, maybe some of you have heard of them, maybe you haven't. That's why I'm here. What is a self-directed IRA? Well, it's the same thing as a Roth, a traditional Roth. Same thing as a traditional, same thing as a Roth, except you have the power to engage. It's not caught up with Charles Schwab or some other type of outfit. It's there. You have a company that's geared. It's really a lot of the uses are for real estate formalities, but it doesn't just have to be real estate. I mean, you can use it for whatever you want, but it's your money, and you make contributions to it. It is tax deductible. Why? Because it is an IRA, and as you know, you guys are doing your taxes pretty soon here. If you make a contribution to your IRA, that is a tax deductible benefit for you. Obviously, it's a tax deferred if it's traditional, but if it's a Roth, then you're actually benefiting from that prospectively. It can be used for entrepreneurial activities, yes, but it also can be combined with an LLC and SCorp for rental purposes, for other types of income producing assets. You can use this thing, like for example, I'll just give you an example. So you've heard of OPM, other people's money, OPIs, other people's IRAs. If you are dealing with hard money, and let's say you go to I'm not going to name a company, but let's say you go get a hard money lender for a rental property or an investment property you want to acquire. That hard money lender, let's say you needed, $300,000. They'll give you the $300,000, but they're going to put like 150 or less of their own money, and then they're going to go to a bunch of people in their network, probably a lot of people who have SDIRAs, okay, self-directed IRAs, and say, hey, I got this proposition for you. They're going to present your business plan for that rental property, and then say, okay, these are the kind of returns we expect. Can you go ahead and put up a portion? They'll put up 10,000, 5,000, what have you, and they'll get a return. And then that hard money lender is going to give the gentleman over here the money he needs to go do the real estate investment, and he flips it, he sells it, or causes it to be passive income through the rental process, or what have you. And when that thing sells, those people get their returns, gains. If it's a Roth, if it's properly set up, tax-free potentially. In some cases, they'll have to have taxes deferred, but again, it depends on how you set up your self-directed IRA, because it can be a traditional IRA, it can be a Roth. And I mean, the only difference is, with self-directed, you're just not having it at the Hang Seng or in the Dow Jones. I mean, you just saw the Dow dropped over 600 points. Friday, today is Tuesday. We're coming up on Valentine's. That doesn't sound like a lot of love to me. I mean, they didn't like what Janet Yellen said about the market. And honestly, there's indications that she might be right. But we've all seen that happen again. We saw it happen 10 years ago, and we saw where that ended up. And so that's, wouldn't be uncommon. The market has had several recessions. It's just the most, I mean, since 2008, since 2009, it's just, they haven't been as pronounced as what happened in 2008. There was a recession in several years ago, two actually, since the major recession. But it's just, it bounced back relatively quickly. It was a bit more pliable, a bit more elastic, thankfully. And so that resulted in an outcome that was favorable to what we see now. And so, let's see. Yeah, now that's pretty much for self-directed IRAs. I wanted to touch on that because that's available to you. That's something you can do within your power. I know I personally have one I set up. I set up one for my daughter as well. My eldest daughter is 5. My youngest daughter is 3. I'm going to set up one for her pretty soon. And you can, as little as $100 to do these things, depending on where you go. But self-directed IRAs are great vehicles. The thing is, if you're not putting anything in them, if you're not doing anything with them, they're not like an interest-bearing account. So they don't necessarily, gain money. But when you start doing things, and once you're ready, like honestly, I would tell you if you had a 401k, if it was my money, I probably would not keep all of it in a 401k. It's a 20th century product. There's a lot more things that are available to you. I would explore the horizons of what has been invented, what has been, gone beyond the learning curve of 401ks and 20th century ideas. Look at what's available in the 21st century and explore opportunities. Like engage a financial advisor, engage a CPA, and try to come up with a strategy that works best for you. But don't just have it all sitting in one basket. And I'm going to give you just some incorporation survival tips. For one, and this is my phone number right here. If you text me, I'll give you a coupon for this product called Mile IQ. Mile IQ is a app that helps people like yourself and myself track expenses. So let's see, I had this, I got this last year. You pretty much says, okay, this is personal, this is business. You just go like that. If you know your drive, you know where you're doing. If you're out, got a bird dog working for you, if you're out house hunting yourself, if you're taking a client on a tour of wherever they want to go for prospects, that's mileage that you're incurring on behalf of doing the business, right? So you don't know what that mileage is all the time. You're got too many busy things, available on you. This is like that's a low dollar skill for you. So have a software that's working in the background that's going to be on you on your phone that you're expensing for your cell phone bill as a business owner, and let that software track your mileage. I know last month I personally logged about $600 worth of mileage expense. Same thing in December. That's a beautiful thing. This software I think goes for like 70 some odd bucks, but I basically get it for around 50 or less. So as a CPA, I have that access for a discount. So I'll give you that, no problem, today. Just thank you for being here. And then you got to keep records. You can't just rely on bank statements. You got to have receipts. You can't rely on credit card statements because it's not going to be supportable really if you were ever under audit. And the IRS does not have to like audit you like we're face to face in person. They can do what's called a correspondence audit and just send you a letter prove this, prove that, and if you don't prove it, I'm sorry, you're SOL about something. So boom, just like that. So next, you can also obviously make sure those records are electronically filed. And again, just to answer my friend's questions over there, compliance issues. You don't want to have your corporate veil pierced. Once you are wisely incorporated as an LLC on the SCorp, you want to make sure that you are doing the kinds of things that a big C Corp would be doing, like Keller Williams would be doing. Keller Williams is not having, you know, they track stuff. They track commissions you guys make, they track what the broker does, they track, you know, this, that, and the other. You just want to make sure you have a formal process. And with the help of a CPA, you can do that. In addition, you know, you want to make sure you have resolutions and bank statements and things of that nature. This record keeping is a really good defense when it comes to audit purposes. So like let's say if you decided you wanted to open up a bank account. Okay, well on this day, what's your name? Okay, on this day, Ariana decided to open up a business bank account to put some money aside for her, and that's actually a self-directed IRA. Let's say you decide to open up a self-directed IRA, and you have a resolution for that, and you approve it in your minutes, and then you go open up a self-directed IRA to put money away for your child or a loved one or something in a Roth capacity, then you will have that documentation there. Does that make sense? Yeah, it's just a record. It's stuff that you do automatically. It's just you put it on pen or paper. So you type it. Yeah, yeah, that's right. All right, so here's just, you know, since you've all been such great students, some helpful action resources, another acronym, you see. But basically, if you give a gift out to somebody, $25 is a max on a gift card, even with the tax reform. Maybe you knew that, maybe you didn't, but sometimes you want to give somebody a gift more than $25 in value if they just bought a house and they use you to buy like a $600,000, $700,000 house. You probably want to give them something more. And let's say you got them a set of cutlery, I don't know, Cutco knives or something, but it has Paul Bradley's name on it and real estate professional.
That's not marketing,
Now, that is marketing.
right?
Yeah, there you go. There you go. All right, so man, y'all are smart. And so, when you start engaging people that's on your team, if you're not set up as a LLC that has outright employees, but you're set up for, you know, maybe you're still kind of starting. You don't want to be dealing with W-2 stuff and payroll. You can just 1099 somebody, and that way, if you're paying them more than $600, and they're a bird dog that's helping you get commission of, you know, I don't know, 15,000. Yeah, pay that person $1,000. Pay them $2,000 if they're a bird dog or something like that. Something fair, and just 1099 them, because that takes the expenses off of you. Because when that commission comes in, obviously, that's what's that?
Yeah,
Well, I should, yeah. That's right. Yeah, the bird dog stuff. Yeah. Well, I shouldn't say bird dog, but if you hire somebody,
it can never say thank you for helping me get this
No, not thank you for helping me get this client. But I mean, if you have somebody that's on your team that's helping you do SEO, search engine optimization, if you have a website, things that are formal stuff, that kind of stuff, yeah. But that thing, yeah, you're right.
But
yeah.
Keller Williams' position is
Yep.
where they will hire people to assist them, and they only 1099 them,
Is that?
and they've already been caught.
Oh yeah. Well, listen to
So
better.
it's a big.
That's right. That's all, like that cul-de-sac talent versus the other talent. Yeah.
Now you can hire the assistant, like Catherine, and you're paying her.
That makes sense.
That's great.
Yep.
But if you hire an assistant,
That's definitely specific to the great criteria that Keller Williams has in the ethics. Let me just finish these slides. The next thing is set up a home office. That will help you have more expenses incurred to help reduce your tax liability. Believe it or not, Netflix, subscriptions, corporate appliances, these things, as a business owner, these can be tax deductions for you. Netflix and subscriptions are just under education. Netflix, like, is there a documentation, or the documentaries on real estate there? Or documentaries on real estate investing? I'm pretty sure. You know, they just happen to have other things that you like to watch as well, but that can be a deduction for you. Also, your children becoming your employees. So if you pay them less than $14,000, they don't have to do a return. Plus, it reduces your expenses as well. Gets expenses off of you. Plus, you can take that money and put it in the SDIRA if you're making that kind of money. Yes, ma'am.
So what is it for
14 without a return, but up to $38,000 for that age bracket or whatever. It'll have a return, but it'd be like 12%. Would be the tax on it, 12%, which is still not bad. But if you can take that money and put it in something that's going to be great for their future, that's something that I would, you know, advise.
And up to what age? 20?
Yeah, that sounds about right. I mean, but yeah, if they're in college, yeah, but I mean, this is even for children, you know, that's like teenagers.
Oh, are you kidding? My kids have been helping me tile.
Hey, but you know your stuff, yeah. All right. The other thing. The other thing I want to tell you about is taking advantage of advertising and marketing. This classification is considered an operating cost, and that, unlike the D-pad, the deal with for flippers and all that, that has been eliminated. But advertising, you know, you don't have to worry about depreciating. That can be fully expensed. So things that classify as advertising, like we talked about the Cutco knives, you know, that would be marketing for you. Obviously, the website development, things of that nature. If you bought a vehicle and had it, you know, graphic designs all over it, you know, that, you know, advertising. So basically, here we are. In summary, just stay with time. Yeah, I've enlightened you about, giving you the cliff notes to the tax reform. I've kind of shown you what will be helpful for you. At least I hope you see that. And you know, you got to take advantage of these things. There's a lot of incentives out there for business owners. There's a lot of things that you can do strategies-wise for tax preparedness, tax planning, including SDRAs, which is one of my favorite things. Well, in my version of REITs, recognizing your opportunity, engaging the right people, incorporating, teaming up with the right people, and seeking out people that's going to help elevate your perspective, help elevate your education, help you become millionaires. Don't become millionaires by hanging around thousandaires. You know, I mean, you gotta get it together. And if you want to be somewhere you've never been, you got to do something you've never done. So you got to take out that leap of faith, attain those goals, and be savvy with this tax reform. You don't need to go out here without wisdom. You have an opportunity to gain and obtain wisdom and engage in the right people. Don't do things sally. And again, I'm going to give you the Mile IQ deal for helping you track the mileage, and you know, just good record keeping. Don't let the corporate veil be pierced. All right. So that's it. So now I can take a few questions. I think we're right on time. Wow. Oh, by the way, this is the discount code. You just Google Mile IQ, and when you download it, just it's BADJ772A. So Bravo, Alpha, Delta, Juliet, 772 Alpha. And so that is what you would put in as a discount code to actually get the 20% off of that software for your phone that works on Androids or Androids and Apples. Now that's the phone number, 1-855 for the bar. If you want to call us, this is my email address right here. And that's, you can text me anytime there. Are there any other questions? Digest this. Yep. Yeah, I'll do tax returns. Yep. Yeah, I'll give you my card. Yeah, I have a bunch of cards up here. Did everybody sign the sign-in sheet, or can we let me pass that around?
And everybody, please fill out.
Thank you very much. Carlos. Hey, no problem.